the market is rigged to stay up, meaning that over a long period of time, the market is going to be positive. Your investments are going to do well. We're not investing because we want to be millionaires tomorrow. We're investing because 5, 10, 20 years from now, we're going to see that all the decisions we made paid off. What's going on? We're back. I feel like we'd be taking too long before recording that episode. How you feel?
I mean, if the people want some more, they should let us know.
But yeah, we're back, episode 15. How are you feeling?
Chilling. We're just recording another episode so we can put it on the Knicks internet.
Oh,
The internet belongs to the Knicks.
We're gonna bring that up.
Didn't I do push-ups?
No, I didn't. No, I didn't say the Spurs were going to win. I said they'll get to the finals. I said they would beat OKC, which we did. The finals, that was a different story. But I mean, kudos to the Knicks though. I won't hate the Knicks. They played their ass off. Like when they had to show up, they did what they had to do. Even though the Spurs had leads in all games, they couldn't sustain it. It just shows that experience matters. Experience mattered in this series.
No, cancel whatever you said, because whatever you said is irrelevant. Now let me say what I'm gonna say. I never said they would win, but you just jumped to that. You said playoff experience does not matter. You said playoff experience is overrated. I'm here to tell you that was a lie.
versus OKC didn't matter. The better team won.
They didn't have their second best player. The Spurs actually had an easy way to the playoffs. Let's be real.
Don't do that.
Let's be real.
Don't what?
They played hobble teams. They played hobble teams. They played OKC without J-Dub and AJ Mitchell. Okay. Who they play before OKC?
The Timberwolves.
Without who?
Nah, he was back. He only missed like one game. He was there. Ant was there. He missed one game. Don't do that.
Ant was the only one. Ant wasn't the only one injured. Wasn't DiVincenzo injured?
DiVincenzo was injured too.
Okay. Did the Spurs have any injured players the whole playoffs?
Yes. What's his name?
De'Aaron Fox for like 2 games.
De'Aaron Fox was hurt. Dylan Harper was out for.
All right. So you're gonna say De'Aaron Fox was hurt? Wouldn't you rather he be hurt based on what he showed you?
Alright, was hurt in the finals. Nah, he played horrible in the finals, man.
It's all good. I just had to bring that up because I did push up, so I'm hating. I'll acknowledge it. I'm a hater.
But no, that was a good series. Kudos to the Knicks. Anybody that's a Knicks fan on here, y'all did your thing. The NBA world can relax now that the Knicks have finally won a championship. I did have a question for you. Now, like we're trying to get back into our episode.
All right, let's do it.
You know the market has been up and down recent. I want to ask you, like, has there been a time when you were scared to look at your portfolio just because the market was red? Or are you just like, oh, you don't care?
All the time. But, as we learn more, as we get more time in the market, you learn to adjust. You learn how to act in those moments. But really for me, when the market pulls back, as long as I have money, I feel good about it. As long as I have some capital, because I know I can buy. But if I don't have capital, then I start thinking a little differently.
That's true. That's true. I agree with that. I think early on in my investing journey, when the market is red, obviously, like most times, like your whole portfolio is red. You're like, damn, what's happening? Like I'm losing money, all of that. But I think now, being more seasoned as an investor, you know that okay, this is a buying opportunity, like you said. And then it's even better if you have buying power. Now I'm like, okay, let's go shopping. Like this is me just like, okay, which of my stocks are like at my price targets, which ones are like down the most, like which should I like add more positions to it. Like that's the time that I really like excited to like see what I can buy. So yeah, so I wouldn't say like I'm scared to open a portfolio, but obviously like it's not as emotional as it was in the beginning for sure.
When I used to be a young guppy in the market, I would delete the app. I'll just delete the app, which I mean, thinking back on it, was probably a good idea, but it was really just because
decisions then, yeah,
it's just because I didn't have a good plan. I didn't really know what I was doing. So deleting the app was the best way to save me from myself. But realistically, I should have got my knowledge up. I should have made a plan and executed on my plan. But you live and you learn.
You didn't even realize. You should go delete the app.
Nah, no, seriously. And I thought I solved the world's most complex problem. Yeah, just delete the app. Uh,
The
the
money should
day,
go.
man, when you download that app back, that rent is
Nah, you
worse than
still be
seven
there.
rent. Is worse. Nah, it's even worse. Yeah, but you live and you learn.
Interesting, interesting. But I mean, yeah. So we're going to touch on that more as we get into today's episode. With that being said, welcome to episode 15 of Common Sense Pod, where we are documenting our journey as two first generation Nigerian-American millennials trying to figure out financially, and hopefully we can all learn a thing or two as we embark on this journey and share our experiences. I'm your host, Umar, and with me is my co-host, Dami. Today, we're going to be talking about market cycles. So we mentioned what happens or how we feel when the market is red. So we're going to talk on what exactly is a market cycle. We're going to talk on what a bull market and bear market looks like, what causes these different market cycles, how you should act as an investor, and what mistakes you should avoid as an investor in these cycles. After that, we're going to touch on everyone's favorite segment, Is It Making Sense? Where we bring out scenarios to figure out if it making sense to either one of us. We're going to touch on economic events, basically the most recent things that are happening in the US economy or geopolitically. Before we get into today's episode, make sure you follow, share, subscribe to the channel. It's one of the best ways you can support what we're doing and keep the content coming. With that being said, let's get into today's episode. So, if you've been following the journey so far, we've been talking about what you should invest in the stock market, some of the financial systems you should incorporate. But one thing we haven't really deep dived into is when you should invest in a particular stock. The reason why we want to bring this up is that ultimately makes or breaks your portfolio. If you're investing at the top of the market, all-time highs, you're investing because of FOMO. Most times you're going to end up losing that trade, that investment, or that profit because you're not investing at the right time. And to make the decision of when you should invest, you need to understand what market cycle we're in. And so that's why at the top of the episode, we talked about, okay, if the market is red, how does that make you feel? If we're in a bear market, are you still investing? If we're in a bull market, if everything is green, is that when you're putting most of your money in the market? Some of these things are things people don't necessarily know, and because of that they don't make the best decision for their financial investments. Another reason why this is also important is because we've seen in the past couple of weeks what's happening in the market, from Trump announcing the Iran war or for calling off strikes. We see how these play a massive effect on the rallies or the pullbacks that's having in the financial market. And so if you're not too familiar with this, you're just going to be caught in limbo, not making the best decision for your portfolio. And so those are some of the things that we're going to touch on. As we always say, we're not financial advisors. We're just on here giving our own knowledge, sharing our own experiences based on the research that we've done. And hopefully you can learn from that as we go on and make money from the financial market. But yeah, Dami, for people that don't know, what would you say a bear market and a bull market are?
Emphasis on we are not financial advisors. If you catch us on a bad day, we are degenerates in the market. We all have those days. So getting into what a bull market is a sustained rise in the stock market. When the market is continuously going up over a long period of time. I'm not talking about 30 minutes. I'm not talking about one day. I'm not talking about a week. I'm talking about over the span of weeks, over the span of months. We see a 20% rise from whatever low we were at to where we currently are. And most times it continues. It's more than 20%. Some of the things you'll see during a bull market is that everyone is optimistic about the market. Everyone feels good. They're pouring their money into the stock market. Everyone's buying. Consumers are spending. And there's a lot of growth in the economy. Those are the things that you'll find associated with a bull market.
Yeah, like Dami said, in a bull market, everything's good. You can't make a bad trade. Everyone is making money. That's ideally what you want in an economy. But on the flip side, for a bear market, that's pretty much when we have a sustained decline for a long period of time. Like Dami said, this is not looking at a day or a week. This is over a long period of time where you're about 20% from the all-time highs. And so in these situations, you have a lot of fear and uncertainty in the market. People are selling so they can take profit, and so you have stocks just falling, free falling. And so these are times where investing might not be the best idea because you don't want to be caught in that avalanche of people selling, and then you end up losing money. And so, understanding when a bear cycle is in effect is important to make better decisions when it comes to investing.
Yep, yep. One thing to note is we talked about a bull and bear market, but we also have corrections, and a correction shouldn't be confused with a bear market. So a correction is when the market declines about 10%, I guess up to 20%, because that 20% becomes a bear market.
Yeah.
But a correction, a 10% correction is almost normal in the sense that it happens almost every year, like 90% of the time. I want to say it's like 90 something, maybe like 94 out of 100 of the past 100 years, there've been at least one 10% pullback per year. So when you're going through a correction, it's nothing to really worry about. In order to continue going up, it has to pull back sometimes. It has to make small corrections so it can continue moving up. So it's nothing to really worry about. Um, and the major thing with the bull and the bear markets is that it's a continuous cycle. As soon as a bull market is over, it transitions into a bear market. And when a bear market is over, it transitions back into a bull market. So they're never ending cycles that play off of one another and continue from where the other one ends. One thing I would like to quote from Warren Buffett, the greatest investor of our lifetime, probably the greatest investor ever, is you should be fearful when other people are greedy, and you should be greedy when other people are fearful. What does that mean? When the bull market is happening, when everyone is buying, when prices are at the top, like Umar said, you feel like you can't get an investment wrong. That's when you need to start being fearful. That's when you should take a little profit. That's when you should sell a little bit. But when we're in a bear market, when everyone's afraid, when everyone's scared, that's the time to be buying. That's the time to be
That's when
accumulating
you
assets.
start buying more.
Yeah,
Yep.
because it's discounted and this is the best price at that moment. So that is what I'll say about bull market, bear market, corrections, market cycles. Let's get into the topic a little bit, Omar. So, why does this matter for you? Understanding these market cycles, understanding bull versus bear markets. Why does that matter?
Yeah, because ultimately that dictates the behavior of an investor. Like Dami said, you want to be greedy when everyone is fearful, and then fearful when everyone is greedy. What that means is that you want to make the best decision when things are not necessarily looking so great. And so this could be known as the consolidation period or accumulation period. This is when, as an investor, you find a particular stock that you're interested in, and then if you see that, okay, it's not necessarily in an uptrend, but it also has positive sentiment about it, this is when you should start accumulating some positions in there, because over the long period of time, that asset is going to do well because it's a good company or is a good stock. And so the reason why you need to understand what a bull and bear market is, you don't want to be one of those that is buying at the top of the market, buying at all-time highs, buying when everything is on their bull run. Because what happens, the market is an ebb and flow. So once it goes up, it's going to come down eventually. What you want to do is to be on that train when it's on the way back up, not when it's already up. And so if you understand these market cycles, it allows you to allocate your money in these funds or these investments a lot better. Another thing people need to realize is that bull markets tend to last longer than bear markets. And so one of the investors that Dami and I usually listen to, Ian Dunlap, he says this one thing, that the market is rigged to stay up, meaning that invest for the long term, because over the long period of time, the market is going to be positive. Your investments are going to do well if you buy at a low point right now. If you give yourself a good amount of time, and we've always said this on our platform, that we're investing for the long term. We're not investing because we want to be millionaires tomorrow. We're investing because 5, 10, 20 years from now, we're going to see that all the decisions we made paid off. Just for context, the average bull market in the US economy lasts for about 5 years. And then the average bear market lasts from anywhere from a couple months to a year and a half. And so just that context allows you to know that if you're investing, most times you're going to be caught in the bull market. You're going to make money in your investment. And so just knowing that's one of the things that you should pay attention to, because that allows your money to grow faster and grow more if you're investing at the right periods of time.
Solid, solid. Another thing that Ian Dunlop says that it took me a while to really accept this in my brain, but all of your problems in the market go away if you hold for the long term.
Hold for the
It,
long term.
it
Facts.
sounds so cliche, but it's simple. It's just what it is. You hold for the
Yeah.
long term, you don't have any problems in the market. When you try to be picking and choosing all that stuff, that's where the problems come from. So Anyways, let me add to that where why it matters. Um, if you understand the cycle, then now you're able to understand how pivotal those corrections and even bear markets can be towards your long-term portfolio,
Mhm.
because you don't see those times as time to panic and sell. You see it as opportunity to buy. Like we said at the top of the episode, in the past, well, maybe not in the past, but for us now, like when the market goes down, we don't feel bad about our portfolio going down because we know it's temporary, but we actually feel good about it because our portfolios are down temporarily, but now I have the time to buy the things that I already own at a cheaper price. And that's always a good thing. Everyone likes a good sale. That's why everyone loves Black Friday, except me. It's the
What's your
government.
issue, Black Friday?
It's the government. The government got you people spending money. You got you hypnotized. You're listening to the
Oh,
man.
oh my goodness.
Uh,
Alright, but I mean, yeah, like Damian said, buy that's pretty much when people say buy a dip, that's what it is. Like when the market is having that correction, that pullback, that 5-10% that looks like, oh, it's the end of the world, that's when you need to be greedy. Like we said, that's when you need to buy the dip, especially like, okay, we're not just saying be reckless. There's also like strategies that we're gonna talk about of how you can buy the dip. But this is when that money that you've put aside or that money that you have in your brokerage account, this is when you allocate it to positions that are that you're positive about, things that you want to be invested in. This is when you do that because now when it's going to return to those all-time highs, now you have all that gain, all that runway to get profit there as well. So yeah, buy the div. That's one of the strategies that you need to do when investing in these market cycles. With that being said, we talked about what a bear market is, what a bull market is, but that's not all the market phases we have. There's things that happen in between or phases that make up this whole market cycle. So, Dami, can you educate the people on what those are?
yeah, for sure. And I'm gonna go ahead and share my screen so we can talk through this. I'll give you a visual as we discuss this one. Hey, yo,
Yeah, I was gonna say pause.
and catch myself, you know. All right, so should see my screen now. Perfect. So what we're looking at is the four phases of a market cycle according to Richard Wyckoff. So he's not the one that founded this, but he modified it. This is actually really old too. This is like old fundamental stock market knowledge,
Yeah.
but he modified it and it's now called the Wyckoff logic. So whenever people talk about the four market phases, they'll usually say Wyckoff because he's, I guess he's the one that made it famous. So what are we looking at here? I'll start from the left side. What we're looking at, the market just came down. There was a sell-off that started right here. And eventually, after every sell-off, there's a place where we find a footing. We find a floor and we balance there. So when we get to that floor of the sell-off and we no longer are making lower lows, that's what we call the accumulation phase. The accumulation phase is where institutional buyers, smart money, this is where they load up on whatever positions they would like to get in. If you notice, there's a lot of volume here initially. This is how the stock starts moving because eventually the sellers that were causing it to come down, that number of sellers has now been overcome by the buyers. So what are we seeing here? There's a sharp increase right here, which is, you can see at the bottom, by a lot of volume. That's what caught the stock to keep it from falling. And then what now happens here is that people are selling, institutions are buying. See, people are selling, institutions are buying. One thing about institutions, they never put all of their money in at once because if they do, the stock is going to rocket. And that's not what they want to do. It's called accumulation because institutions are using this to take all of your shares. So while you're panicking and selling them, they're buying them from you for the low and you don't even know it. Notice how the volume starts to decrease here. Most accumulation phases don't have crazy volume. They might have high volume in the beginning, but the volume is pretty regular and it gets low. A lot of times you'll see before a stock breaks out, the volume is really low and then it takes off as you see here. So this accumulation phase is just the smart money. They're taking up all of our shares because us retail, we tend to sell when we're scared. And eventually the volume of buyers will overtake the number of sellers because institutional people have bought. Retail is tired of selling. So some of the people like you watching this episode right now decide I'm going to buy as well. And what happens? The stock moves up. And One thing about institutional money is that they always manage their risk. So when the stock goes up here, what happens? They sell a little bit. When they sell it, us retail people are like, oh, the stock is moving up. I'm going to buy it. They're going to sell it again. Us retail, we buy it again. This is the markup. I don't think I mentioned that. Sorry. But we go from accumulation to the markup. Eventually, we reach the top or the buying climax. And that's the point where, just like how we transitioned over here, the number of buyers and the number of sellers is becoming very close now. So it's a tug of war of who has more power. Do the buyers or the sellers have more power? So we're in this range up here. We're not going up or down. But one thing about institutional money, they've been selling this whole time. While we were buying it, they've been selling it. They've been selling it up here. They're selling it. They're selling. At this point, this is where retail starts to catch on that I should probably start to get out of this. It doesn't look like we're making a new high. Now, institutions are selling, retails are selling, but most of us are not selling because we're trying to catch the wave. This is the distribution phase. It's the opposite of the accumulation. Whereas the accumulation, think of it as like it's like a spring being tighten so that it can pop, then the
Mm.
distribution is the exact opposite. Now there's no more energy in the spring. It's slacked. Like there's nothing else to push it forward. So now, what do we see here? Eventually, when a stock fails to make highs like one or two times, if you see a stock hit the same price one, two, three times the same high, we're probably coming back down because that means we didn't have enough volume for the buyers to continue to push the price higher. Now the price is going down. This is where it gets bad because the stock market goes up like stairs, but it goes down like an elevator. So we don't really need as much volume to go down as we do to go up. To go up, think about it. If you're going up a mountain and you're pushing a boulder, it's going to take a lot of work to push that boulder up the mountain. And then you get to the top and it's kind of like flat. It's neutral. But once you try to go down the mountain, you push it a little bit, it's gone. Same thing with the stock market. So high volume is a plus, but we don't always need high volume to get into a downturn, into a bear market, into a correction. So now that we've gone from the distribution phase, we're now in the markdown phase. This is the exact opposite of the markup. So we're making new lows. Everyone is selling. Institutions probably have taken most of their profit. The latecomers are taking their profit or panic selling here. And panic selling from people leads to more panic selling. And eventually what happens? We get all the way to a bottom and get back into the accumulation phase. So like we mentioned earlier, it's just a never ending cycle between bull and bear markets. And these are the four phases that happen. One thing to note though, is that every markup phase does not lead to a distribution. Sometimes we can go from accumulation to markup back to accumulation again for continued bull move. And same thing on the downturn. We can go from markdown to another distribution to another markdown. So you have to just be aware of the signs or be aware of the signals during these times so that you can make the most of these situations while you're in them. So that's that on the market phases. Stop sharing.
Nah, that was good analysis, like a breakdown of the different market cycles. Like that providing the visual allows viewers that don't necessarily understand like what stock charts or what charts look like to see what that movement looks like when we're talking about the different phases. I like how you said that the accumulation, this is where the smart money is. So like your banks, your hedge funds, your investment banking, this is where like they're adding their positions. Like when you're selling, thinking that you're taking profit or thinking that the stock is like not making any money, this is when they're adding positions so that when that markup happens, they're making money and then they're eventually selling. So that was a good visual. I feel like anyone that saw that got a good understanding of what the different market cycles are.
Yeah, yeah. That was
I didn't,
basically the breakdown. Go ahead.
yeah, I was gonna say I didn't even know about that. What was his name?
Wyckoff, Richard
Wyckoff?
Wyckoff.
Yeah, yeah. I
Yeah.
wasn't familiar with him, but that was good.
Yeah, the more I learn, the more I can name drop.
He
Somebody's
had
in the
he had
weeds.
two name drops already. You said Warren Buffett.
Yeah,
All
people are in the
right.
weeds when they start naming people and you're like, who is this person?
Nah, facts, facts.
Yeah. So yeah, those are the four phases of the market cycle. Let's move on to what really causes these cycles. Well, I mean, we've talked about it from a basic perspective of volume, institutions, retail sellers, but what are the things in the economy? What are the things that are actually going on that may cause us to get into different phases within the market.
Yeah, for sure. So obviously, these market cycles are not happening by themselves. There are forces that are happening within the economy or within the world in general that's making these market cycles to happen. And so one main one, as we've talked on, like we've mentioned that these bear cycles, they're pretty much measured by using the index funds to see how the economy is doing. And so within index funds, you have companies that make them up. So you have the S&P 500, which is the top 500 companies in the US economy. You have the NASDAQ, you have the Dow. These are all index funds that are used to measure what's going on in the market. And within them are the companies. And so, dependent on how the companies are performing, are usually a good indicator of what these index funds are going to look like and overall what the market is going to look like. So, if these companies are having good earnings, they're big on innovation, they're net positive on their earnings report. People are willing to buy their stocks even at premiums. These are all good signs that, okay, companies have positive earnings, companies have positive sentiment around them. And so people are going to invest in these economies. Think about the market right now. A lot of these companies, because of the AI growth and infrastructure, a lot of these companies are seeing people invest in them. Think of, you have Snowflake, you have Nvidia, you have Micron. These are all companies that, because they're having positive earnings, because they're making money for their investors, people are investing in them. And that ultimately what happens, the NASDAQ, the S&P, those are also nearing all-time highs. And when that happens, the stock market overall is doing well. So that's one of the forces that drives market cycle. And so if we have companies that are not necessarily producing, people are not positive, people are not investing in these companies, they're not making money, then we're in a sign that, okay, maybe this is not the right time to invest in the economy. These are the companies are not making money. There's no reason for me to put my money here. And so that's another sign. That's a sign of a bear market. And so with how companies are doing on a day to day, that gives you a good indicator of what market cycle we're basically in.
Nice. So another one would be interest rates. So we talk about interest rates a lot on this show because interest rates are what guide fiscal direction within this country. How so? Let me tell you.
This man asking himself questions in third person. Oh my God.
It's the aura, man. It's the aura. So when interest rates are low, borrowing money is cheap.
Yeah.
People tend to expand on their businesses because if I want to add another leg or another part to my building where I'm selling things, if I wanted to increase my stock, I'm going to borrow the money while it's cheap to borrow that money. So when interest rates are low, businesses expand. There's a lot of growth in the economy. People are spending money overall. So during these times, people are more willing to put money in the stock market because there's a lot of growth going on in the economy
Hmm.
and there's less risk because of the growth. Whereas on the other side of this, and this is why our new Fed chair coming in is such a big deal, because if interest rates are higher or if interest rates are going up, what does that mean? That means people are not going to be borrowing money because the interest rates will be
It'll
worse.
be more expensive.
It,
Yeah.
it means that businesses will not expand. It means that there's not going to be as much growth because it costs more to do these things. It means that people will remove their money from the stock market because it's not as guaranteed during those times and put their money into safe assets. I mean,
Yeah.
if the interest rate is at 5, that means your high yield is giving you 5%. That's not the stock market, but that's good and safe enough for most people. Most people
Hmm.
are cool with
Hmm.
that 5%. So they're going to take their money out the market and put it in the high yield. They're gonna leave it there until maybe, I don't know, maybe until rates get to like 3.5, 3.25, then they want to go back to the market. So that's why this new Fed chair, Kevin Warsh, the situation with it is such a big deal because if he increases rates, it's going to rub a lot of people the wrong way. They're going to feel differently about the economy. They're going to feel differently about businesses as a whole. And people are going to run to safer assets. And that's part of this cycle that we talk about.
No, that's a big one. Like we've talked on interest rates a whole bunch in our previous episodes, but pretty much if it's more expensive to borrow money, people are not going to do that. And so if you're
Hmm.
increasing rates, you're making it difficult for people to actually invest into their business, invest in the stock market, borrow money to start businesses, anything they need to. So it's like we said, it's a balancing act to figure out, okay, how are we going to balance interest rate, but now also not lead to inflation. And so definitely is gonna be interesting to see what's going to happen. But that is definitely a major factor that causes the different market cycles that we have. Another big one that I feel like this is the most unpredictable one is external shocks. So think of like natural disasters, think of COVID that we had in 2020, think of 9/11, think of the 2008 financial crisis, or just even a recent this year, the Iran war. These are things that can drastically take you from either a bull market or accumulation phase to just like a bear market because of what's happening in the economy. Because it's so unpredictable, it causes people to panic in these situations, and so it leads to like large sell-offs. So, Dami, how do you feel that I guess these external factors like play when it comes to the market phases?
Well, you missed the biggest one.
Which one?
Trump. Trump tweets. That's the biggest external shock.
That exactly. That's another one too that we have to take into consideration. True.
Yeah. Yeah. Um, you asked me how do I feel it plays into
Yeah.
factors.
Like
I
compared to
mean,
the others for sure.
like you said a little bit, you mentioned a few of them. It's like most of the time these external factors are not good things, you know.
Hmm.
They lead to bear markets. So like you said, COVID, 9/11, 2008 great financial crisis, even Trump last year with tariffs. So
That yep, that's another one.
these type of things change how people feel about the economy. They change how people feel about the stock market as a whole, or it just change how people's livelihood is. Like an example of COVID. And during those times, people are fighting for survival or people are fighting for their livelihood. They're less likely to invest. If they're less likely to invest, that's a lot less money going into the market, which can lead to bear markets. So these external shocks are usually negative things.
Negative, yeah, negative.
hmm hmm Yeah. Another one is investor sentiment. And that's just the average person like you and I, how we feel about the market. So the way the stock market moves, it is a big compilation of buyers and sellers. When people feel good about the market, they buy. When people feel bad about market, they sell. And think about that for every company that's in the stock market. So every company has a combination of buyers and sellers. The market as a whole has buyers and sellers. When we're going up, it's because there's more people buying than selling and vice versa. So that's really what determines our phases.
Yeah.
When things are going well overall, people are buying more than they're selling. When people don't feel good about the state of the economy, people are selling more than they're buying. And that in itself can lead us to different parts of the phases. Anything you got to add there?
No, that was a good one. I mean, like you said, like pretty much is how us as individuals, not even just institutions, but like retail investors, how are we feeling? Like, are we like, okay, let me put my money in the market because I'm going to make money, or hey, let me stay away from the market because people are losing money. Like those are actual feelings. And like you said, I like how you broke it down. Like each company in the market has people that are buying their stock and selling their stock. So are the buyers more than the sellers? If the buyers are more than the sellers, the stock is going to go up. If the sellers are more than the buyers, the stock is going to go down. And so, as if you aggregate that into the U.S. economy, it's pretty much are there more buyers in the economy or are there more sellers? If there's more buyers, that means everything people have positive sentiment towards the market. But if there's more sellers, okay, there's something going on. People are not people like you said, people don't feel safe putting their money in the market. Now they're going to find other assets to invest in. So like you said, like that's a good one. That investor sentiment is a big force that drives the different market cycles that we have. Some other key concepts that to recognize that can also cause these market phases would be, as we mentioned, the Fed policy, what they decide on interest rates, what they decide on inflation, what are earnings of these companies looking like? Are they positive earnings or are they missing on earnings? Is there any geopolitical issues? Are we at war with Iran? Is China beating us in the AI race? These are all things that can also cause the ebbs and flows in the market phases. So just for people to be aware of that as well.
Yeah. Emphasis on the wars and like the China stuff because it- it's really understated how impactful those things are because they affect the position of the US as a world
Hmm.
leader.
Yep.
And if we're not world leaders,
We're not the world leaders. What are we?
nothing for us. Nothing for us in this
What
country.
are we? Because America doesn't want to be number two. It's
We
like
can't be
either
number two.
us or nobody.
Nah, facts. If America is number two, this planet would be completely different.
We don't want to get into that one.
Don't even want to
All right,
imagine it.
all right, all right.
Imagine
So
imagine us having to look up to like Russia or somebody or China. Like that's the new big dog, and I can't even imagine it.
nah, Trump would not allow it.
Trump would never let that happen. I can't even lie. He would never let that happen. Not
Trump
under his watch.
would send out the nukes before you let that happen.
Wait. On the whole planet or just Russia? What do
Bro.
you think?
Nah, I mean, if you send it on Russia, you have to know they're going to attack back. So it's like,
Uh,
you already know
so
it's a
okay.
mutual assured destruction before that happens. Let's pray. All right, but I was gonna ask you. So, as someone that is aware of these market cycles, what would you say are some mistakes you should avoid, so you don't lose money? Pretty much.
Uh, a big one is trying to time the top and the bottom of the market.
Yep,
Nobody's really. Don't get me wrong. People can make high percentage guesses, and there are obviously people who are experts, and they're a
yep,
lot better at timing the period. But no one can guess the exact top, and no one can guess the exact bottom. And you and I, as retail investors, we definitely can't do it. So there's no point of trying to lie to yourself, and
we try our best, but we try
we
our
try
best,
our
but
best,
sometimes
but
our best is
it
not
takes
good enough.
years. It takes
Yeah,
years of experience of watching the market, of being in the market, of trading to even be competent as an investor, not to now talk of being able to time a top or a top or bottom. I mean,
yeah.
time a bottom. So you shouldn't just stay in the market, like we said, invest for the long term.
That's a good one. That's a good one. Another one I would say is stopping contributions during a bear market. Not gonna lie, I've done this before. I was like, I like this money that I'm putting in my investment account, I can use it for something else. But looking back at that, that's probably a bad decision because not probably. That was a bad decision because that money that I was automatically putting in my investment account, when the time was right, I could have allocated that and got a bigger position like when the market was red and added to stocks that I wanted to. But because I wasn't feeling confident in investing at that time, I was like, okay, it's a bear market. I don't need to be putting money in here or I'm going to lose it. But that's like we said multiple times in the episode already. When people are fearful, that's when you should be greedy. If I had known better at that point in time, I was like, okay, I have money coming into my investment account on a recurring basis. Maybe I don't maybe I don't buy anything right now, but that doesn't mean I need to stop that contribution. Maybe I just let that contribution add up. And when we can see that there's a reversal or the market is starting to go on that uptrend, okay, now let me start buying because prices are a lot lower from how they were a couple months or years ago. And so that's one thing that people shouldn't do. Learn from my mistakes. Don't stop contributing to your investment account just because the market is red.
Yeah. Don't feel bad about it. I've done the same thing. It happens,
But that's why we're here.
Yeah.
That's why we're here.
Being an investor is tough. Like the trials and tribulation you have to go through to be competent, not even like good, just to be a little bit,
Decent,
just to know a
yeah.
little bit of what you're doing. You got to go through a lot. But like you said, that's why we're here because we've been through a lot. So another one would be confusing a correction with a crash. So we
Yep,
mentioned earlier in the episode how the stock market does not go straight up, it does not go straight down. So a lot of times we'll be going up for a long period of time. I mean, we're literally going through it right now,
yeah,
or we just went through it. The stock market had been running in all-time highs. I think we were running for like 7, 8 weeks, green weeks straight, and we just had a 5% pullback. Did it feel bad? Honestly, this one didn't feel as bad. It was
wasn't
just
too
that
crazy.
one day.
Yeah,
Yeah, I think it was that Friday. That was kind of bad because of how intense the drop was. But overall, it wasn't too crazy. But it's just a healthy uptrend. It has to pull back at some point so it can continue going upwards. So when the stock market pulls back 3%, 5%, 7%, 10%, does it feel great? No, but there's nothing to panic about. I think until we get over 10% and then approaching like 15, okay, now you can start to observe, or now you can start to change your sentiment, how you
Yeah.
feel. But anything under 10%, there's no reason to panic about the stock market going down.
Relax, relax.
Nah, for real, you gotta chill. You gotta chill. That's how you get on the brokerage and you just start pressing buttons. I know because I used to be one of them people. You open that
You
brokerage,
just like,
everything is just red. It's like you have an out of body experience. Have you ever done that before? Bro, it's different. And then you be like, when did I do this? How did I do this? Crazy.
nah, I wouldn't say I've gone that crazy.
I've done it. All right, all right. Let me take us into our next part then. All right, so moving on from mistakes to avoid, let's talk a little bit about best practices or the right way to operate in the market during these cycles or during these phases of the cycles. Tell us some of the good things we should be doing, or the right way to maneuver.
All right, for sure. So this is one that, especially if you're a beginner into investing, that you should incorporate into your strategy. That is dollar cost averaging throughout every cycle. And so we've mentioned this in our financial systems, but this is one where you just automate your investing. So let's take the S&P 500 for that. So every time you get paid, every paycheck, you're investing a certain amount into the S&P 500. So it doesn't matter if it's in a bear market, in a bull market, or whatever phase it is, you're just constantly investing in that. What happens is that as a beginner investor, by doing this, you're taking away the thought process of figuring out when to time the market. If you're dollar cost averaging, you don't have to think about, okay, am I buying at the low? Am I buying at the bottom part of the market? Am I buying at all time highs? Regardless of what you're doing, you're constantly adding to your position. And like we've said in the episode, bull markets tend to last longer in a bear market. So over time, you're going to be investing in the stock when it's doing well. And so that will automatically give you a higher rate of return rather than trying to time it. Because one thing, if you're trying to time the market, you might just end up being on the sideline, never actually participating, never actually putting your foot in the water because you're like, okay, maybe the stock is not low enough or it hasn't gone to the price that I want to. But if you're just dollar cost averaging, regardless of what's happening, you're going to be investing. Yes, you might not get as high of a return if you invested at the absolute bottom. But as we've said, you can't time that bottom. And so what happens if you never really get to that point in time? And so as a beginner, I'll say this is one of the strategies that you want to incorporate because that gives you a foot in the game at least. And then maybe when you get more experience, you can start making better decisions using technicals to find better entry points. But as a beginner, definitely say dollar cost averaging. Another thing that I wanted to highlight is that we mentioned this throughout every episode. We're investing for the long term. We're not trying to be millionaires tomorrow. We're not trying to get 100% return right away. We're trying to invest for 5, 10, 20 years down the line. And with that, you see that regardless of where you invest, regardless of if you invested at the top, at the bottom, if you're investing in a good stock in a good company, you're going to see over time that investment is going to do very well. So just to highlight this, let's share some visuals so people can get a better understanding of this. All right, so here we have the S&P 500. As we said, this is basically the top 500 companies in the U.S. economy. So what happens is that sometimes companies are taken off of the index fund and are replaced by other better performing companies. So that's how they pretty much measure this. And so one thing I wanted to highlight, let's say you're someone that started investing this year, 2026. And so this is the start of 2026 January. You invested, market was maybe at about 6,900, 7,000. And so you can see that at March, the market was down almost to 6,300. And so if you invested here, you're wondering, wait, why did I invest here? I'm losing money. The stock market is a scam. And this is around the time that Trump announced the Iran war with the Strait of Hormuz. Yeah, and so you're here wondering like, "Wait, I invested, I'm losing my money, I don't believe in investing anymore, I'm taking all my money out." So imagine if you sold here at this point and you exited the market, but look at today in June, the market is back to 7,500, 7,600. So what you basically would have made more money from what you had invested early in 2026, beginning of 2026. So over that short period of time, that's just 6 months within the year. You've already made money, but you exited the market just because there was one downturn within the market. And that's just to show you that this is an ebb and flow game. Like it's not just a straight shot to the top. You're going to have pullbacks, and these pullbacks are when you should take advantage of that. Let's look at a longer time frame. And now 2020, we talk about 2020 a lot. This is when COVID happened. Everything was going the turmoil. January, March 2020, stock market went all the way to 2200.
From
And
where?
oh, from here, we're looking at, yeah, 3,300, 3,400 around there. And so market pulls back. Everyone, if you invested here, you're like, oh my God, I'm losing all my money. But if you had left your money in the stock market over 5 years, this is over this is over 3x of your money. So if you put 10,000 in the market here, you should have about 30,000, 40,000, depending on what you're investing. And that's just because you held for the long term, and then instead of panicking, you let your money grow over a long period of time. And then just for more context, now let's look at like a 10 20 25 years. Let's do that.
Start of the century.
Yeah, start of the century around here. All right, so 2000s around here. 2000s around here. Let's say 1500, 1600. All right, so just for context, if you're looking at the top of the century, like we said, 2000, we're looking at like right around here, and we're going all the way, yeah, all the way to current day. That's about a 400% return on your investment. So if your parents had invested for you, or if you're someone that had invested in the early 20s, you would have made about 400% return on your money. And that's pretty much what we're trying to preach when it comes to this investing game. We're not looking to, I mean, yes, it would be nice if we made money right away, but we know from investing that that's not always going to happen. And so what we can do is provide that foundation for us to continue to grow our portfolio. And then over a long period of time, we'll see that decisions that we made now are benefiting us in the future. So that was just one thing that we wanted to show, that look at the bigger picture. Don't look at just what's happening in the market today, because this is a long-term game, not just something that we're doing um casual. This is not just something we're doing casually.
For context, that 400% over 25 years means that if your parents put 10K into the market when you were born, when you were 25, that 10K is 50,000 and you didn't have to do anything.
Nothing.
Imagine that being your life right now. Your parents saying, "Oh, we did this and now you have 50,000. We didn't have to do anything else." It's the power of the stock market.
All right. But yep, that's what one thing we wanted to show when it comes to investing. Always think about that this is for the long term, and then eventually it's going to pay off.
Nice. That was good. The visualization, hopefully that resonated with some people. So some other best practices, and I got two that I've recently gotten a lot better at. So the first one would be to keep an emergency fund. When I say emergency fund, I mean this in two sense. One is my emergency fund of life. So like, I don't want to ever be in a scenario where because of certain things going on in my life, I have to dig into my stock market investments because like Umar said, the goal is to leave that to grow infinitely for however long I can. But also, I guess, all right, so I like to keep money in my brokerage account, but I also have some money like that I keep in my bank account. Like if the stock
Hmm.
market gets there, this is going into the stock market. This is like, I'll replace it. It might even be from my emergency savings,
Like a lump
honestly.
sum, yeah, like a lump sum
Yeah,
that's ready
yeah,
to go.
exactly.
Yeah.
Like, to be honest, I'll probably take some from my emergency savings and just like,
Hmm.
build it back up. But you want to make sure that you have that money available. So when the opportunities present themselves, you can take advantage of them. Like Umar just showed you, those corrections, those bear markets don't last long. So if you're able to not pick the bottom, but if you're able to take advantage of those times and put a little extra money during it, now you're getting double the benefit of it. So
Yep.
you,
Yep.
you want to make sure you have some capital. Umar, we said it like 3 times this episode. Like when you're going through those downturns and you have money, you feel completely different than when you don't have money. And this is coming from someone who's been on both sides of the coin.
Yeah.
And when you don't have money, it's not fun at all. You have to wake up every day, look at your portfolio, and know
Pretty
that you
much you
cannot do
can't do
anything.
anything.
You
Yeah.
cannot do anything. The only thing you can potentially do is let your emotions take over your mind and sell. And that's the last thing you want to do. So try to keep some capital. The other one, and this one is actually a sleeper, but rebalancing your portfolio.
Mm, yeah.
I didn't used to do this at all. I did not used to do this at all, but I've gotten better at it now. Like, and rebalancing in the sense that just like sometimes you have certain things in your portfolio that run to the moon. Like if you have MU or SanDisk in your portfolio right now, you might want to take some profits because you never want your portfolio to be heavily weighted by one thing.
By one stock, exactly.
Because when it's going up, it seems great, right? But think about the other side. Think about like if MU or SanDisk were going down precipitously, or like think about like MicroStrategy right now. And I know that because I had to cut it from my portfolio. Think about if most of your portfolio was something that's going down, or most of your portfolio is Bitcoin. It's gonna hurt, and it's gonna
Mhm.
hurt really bad. So you gotta make sure you're balancing your portfolio over time. Like when one particular position is getting large, you gotta trim it a little bit. You gotta balance it, put it to somewhere that's hurting, put it into a new investment. Um, and you don't have to get all fancy with it, but it's definitely a good thing to do. Managing your portfolio.
Yeah. And just to add there, I'll say like, I mean, that like you said, you just start adding that. You've been investing for like, let's say if like more than 5 years, let's just say more than
For
five
sure.
years.
Yeah, yeah, yeah.
And so it's like, obviously we're not saying that this is something like a beginner needs to incorporate right away, but the more you are experienced as an investor, you figure out things that you should do. Like I said, like Dami said, you don't want one particular stock to be the majority weight in your portfolio, because if that does bad, your overall portfolio is going to look bad. And so if something does well, sell and then reallocate, or like enter at a different price target or different price point that you can. Like, especially if it's not an ETF. Like, if it's an ETF that's heavily weighted, okay, that's fine because it's not going to be as drastic if it pulls back. And then ETFs are generally weighted well. But as an individual stock, like that's something that we've had to learn, that you don't want that to be the one that's basically carrying your portfolio on his shoulder, pretty much. But yeah.
See, see, I don't. People may not have caught that, but you actually was giving some next level game right there.
Nah.
Trimming your position at a high and holding it and re-entering at a bottom. That's top tier right there. That's top. Like imagine doing that with SanDisk or MU just like this past few weeks where it was running
Mhm.
up. It pulled back significantly. In the grand scheme of things, it wasn't that big of a pullback, but for the moment, it was a big pullback. And you could have bought the same thing that just made you money for a cheaper price off the money it already gave you. So that's a good game right there.
Sure, for sure.
Cool. So now, we got to get into the signature part of our episode. Let's talk about our personal experiences. So I'm not going to make it a question. I think I'm going to leave it open ended.
Yeah.
If you just want to talk about any particular bull or bear markets you've been a part of, or any part of these cycles that um, are memorable for you in your throughout your investing experience.
Okay. One that comes to mind right away is, don't inflate your lifestyle based on like a market cycle or because of a bull run. That's how I'll phrase it. So just thinking back, this was last year, so this is why this is fresh. But this was last year around uh let's say August, October, around that time. And so this is when like we had that April pullback. I think we were down like 10%. It was a correction. And so people were buying stocks. Everything was doing well. And so that whole summer, we were making money from any trade that we did. Money was flowing. And
April was
so
down 20%.
20% exactly. So imagine like, okay, so when things were down 20%, if you bought anything that was on that run up, you were just making money. Money was being printed out. And so, like, I think during that time, like, I remember vividly, like, in October, this is when, like, I bought my Nigeria ticket because I was like, okay, I'm going to Nigeria. With what was going on in my head was that, like, oh, I've been making, like, so much money in the stock market. I'm making so much money in the stock market. Let me buy this ticket. I mean, mind you, like I've sold some options, but some of them like have not materialized. Like these are just options that are high. Like you can see
Unrealized gains.
unrealized gains, basically. So you can see like your portfolio is doing well, but like that's not real money. Anyway, so I bought my ticket. I was like, okay, let me buy some clothes. Let me buy some shoes. You have to look fresh when I go into Nigeria. And I can't just be looking any
Of
type of
course not.
way.
I said I want dead seat.
Can't just be looking exactly this is December. You have to go have a good time. So in my head, I'm like, okay, I'm gonna have like a good amount of money going to Nigeria that I'm gonna spend there. But come and then also like in December, usually what happens is that you also have that Christmas rally that also like that provides some type of volume to stocks going to the end of the year. So that was all like in my head. I was like, there's no way I want to lose money in the market right now. But if you look at the charts, if you look at what happened from October to December, it was a pullback. Like all the gains that we had gotten like from April to like summer, July, September, those there were pullbacks like from October to November. So all those gains that I was thinking that I was gonna get, I didn't get them. Like I had to like cut some options short. I took losses on some just because I had inflated like my lifestyle thinking that okay, I'm gonna make money based off this market cycle that we're on. But like we said, you can never perfectly time a market cycle. You don't know what's gonna happen. You can do your best guess as an investor, like we said, like I said, I thought there was going to be a Christmas rally. That didn't end up happening. So now I'm left holding the bag of like things I was expecting to happen in the market that didn't happen. And then it caused me losing money, not making good financial decisions. And so that was one that I vividly remembered. I was like, oh, never again. Like, I mean, I had the money to buy everything I need for Nigeria, but like in my head was like, I'm going to have extra to do more,
Extra. Yeah. Yeah.
exactly. So
Yeah.
that was one that I remember vividly.
I always talk about it. It's just tuition. It's some tuition is expensive, some tuition is cheap. But the good thing about those type of situations is that, like you said, never again. Like literally never again.
Yeah.
Yeah. I have similar experience. I think about 2021 during
Mhm.
that bull market run, it's like you could do nothing wrong in the stock market.
Yep.
Anything you bought was going up. And that was the time of it wasn't AI, but that was the time like the
No,
tech
that
run
was
before this
semiconductor.
tech
That was
run.
NVIDIA. That was
Exactly.
NVIDIA.
Yeah.
That
That
was
was like
NVIDIA,
the
Tesla.
that was the tech run before this current AI
Yeah,
tech
yeah,
run. That
yeah.
was what built for this. So like everything was just going. Man, you could buy a weed stock. Weed stocks were going up. Man. So that
Oh,
was
are
a
we gonna get into meme stocks too? The
Bro,
meme stocks
meme
are
stocks. That was a
oh
different time. That was a very different time in the stock market. And just like I said, anything you bought was going up that time. It was
yeah.
just very different time. But there's no lesson there. I just remember that. But for me, lesson wise, it would have to be last April. That April, the same year you're talking about that you benefited from making money and then you didn't sell at the end. Well, I got burnt bad in the beginning of the year, you know,
Yeah, yeah.
so you were expecting a Christmas rally, but the prior year we had a good Christmas rally. So I came into the year feeling good. My options account was growing. I remember I had to be up like 40, 50% on the year in
Mhm.
February, March. Like, and you learn it, but you get to a certain point where you're like, I can't even lose money. You be like, I can't even lose money. When you making
It'll
money in the
shock you.
market, bro, and that's when you lose the most money. So man, I was like, man, I'm taking profits. My trading account is going crazy. And
Yeah.
this is where I messed up. I usually, at the time, what I was doing is I had a trading account, but whenever I got a lot of capital in it, I would buy shares just so I'm not only trading options in the account, just to
Mhm.
balance it out a little bit. But man, I was making that money. I sold all the shares. I sold all the shares and Trump started talking about tariffs.
Yeah.
That was the worst 1 month or however long period loss I've had in my life of trading. I've never lost that much money in such a short period of time. And I was trading options, so the money was gone. And I learned so much from that period. But, like I said, it's tuition. That period is what transformed me. That's what made me take my investing journey to a different level because I
Mhm.
said never again. I said I'll never be fully in options in an account. I will always make sure I have capital. And, those are two of the big things that really stuck with me is that I always make
Yeah.
sure I have capital, and I will never make sure that all of my money is in options in my options account.
I mean, like you said, tuition, it might
It's
be
tuition,
expensive.
bro.
It might be
So sometimes
expensive.
that tuition is expensive, but sometimes, the cheap money you were losing wasn't enough to teach you the lesson. You had to lose a
Bro.
lot.
Nah, that's good. Like you said, that I mean, like yeah, if you're caught in that April, like you said, 20% drop, like I can only imagine, especially if you didn't have a stop loss. Oh yeah, you're cooked.
Now I was on Robin, there ain't no stop loss. Man,
But and I mean that's why we're bringing up like all these like personal experience because we've gone through it like the different market cycles. We've been investing, like we've seen the good days, we've seen the bad days. Like they're like it's going to happen. But what you can do from all these experiences is that take the lessons in there, figure out like what you did wrong, why, like what you can do better, and then implement that. Like Dami said, I mean, I can like Dami, he's like he's the go-to trader now because of that experience that he had. Like those are some of the things that transform him into how he trades and make decisions today. So
literally, like you said, never again.
yeah.
Never again.
All right, cool, cool, cool. That was a good one. That was a good one. I like
That
the
was good.
different experiences that we have.
It's funny how we had similar experience in the same year at different times.
All
Man,
right. Moving on to everyone's favorite segment. Is it making sense? This is where we bring up real life or made up scenarios and we decide if it's making sense or not to us. All right. So you have this person, they started investing in 2020 during COVID recovery. Their portfolio grew significantly through 2021. As we can see, we saw what happened from 2020 to 21. The stocks were doing great. So when the market started pulling back in 2022, they decided to sell everything to protect their savings. So since 2022, they've been sitting on that cash, waiting for the market to be at the right spot for them to re-enter. And now the market is at new highs. Is that making sense or not? Sitting on that much cash.
so this person clearly did not have a plan. They
Mm,
clearly did not have a plan because, uh, personally, would I say someone should sell all of their account? No, but maybe they had a personal reason. They had a plan why they should do it or they're going to do it. But
yeah,
to be sitting on that type of money and not deploying it into the market, and it's been however long since then,
like
it's not
four
making
years.
sense.
Yeah,
Yeah, it's not making sense. Like it might have made sense. Well, they almost had something because we technically went into a bear market right after that when the
yeah,
pandemic started. So if they, had the thought of, I'm going to buy into the market, if the market goes down 15% or 20%, I'm going to deploy all this capital. That's not a bad plan. You can't anticipate the drop, but maybe they knew something we didn't. All in all, I'm saying this does not make sense because one, this person is wasting potential compounding time in the market. Two, they're not doing anything with their money. And if your money is not doing anything, you're losing to inflation. So no,
yeah.
it does not make sense at all.
Yeah, I agree with you. I think this is not making sense. Holding onto cash for that long, waiting for the right time. I think there's two things that's happening here. So one is like this person, we've talked about like you can time the market, and that's exactly what this person's trying to do. They're trying to time the market perfectly. And you can't really do that because you never know where the bottom is. You can only like assume and have a best guess, but you can't accurately predict that. Another thing, I think this person is basically like a beginner investor or like an accidental investor. So like in
Mm,
2020, maybe they
yep.
bought like Nvidia for like they bought like five Nvidias. They
They
made
didn't
like a
buy
good
Nvidia. They
return.
bought GameStop.
They bought GameStop or something, and so they sold, took the profit, and so now it's like they don't know what else to invest in. So I think that's like a beginner strategy. They hit a lick in 2022, made some money, and so now they haven't like redeployed that. So this is not making sense. I mean, like you said, it was a good strategy selling in the beginning, like taking that profit. But now it's like, okay, now redeploy that capital to invest in something, make your money make money. You're losing money into inflation if you just have it sitting somewhere without doing anything with it.
And let me add to that because you made a good point there. You said this person is probably a beginner and doesn't know what they're doing. That's exactly why they're scared to invest because the first money they
Mm,
made was lucky. It was
yeah,
lucky money. So they don't know what to do again. Maybe the gains blew their mind and they're like, I know I really didn't do that. So I don't know what to do. So that's a
yeah.
good point you made there. Cool. Good alignment on that one. All right. So now I have one for you. We have a girl. You know, I'm appealing to the ladies, so all my examples will always be girls. We have a girl. Hold on, ladies. Any lady watching this, give us a like, please. Show us some support. Our algorithm says ladies don't like our stuff, and I don't know why. I
Yeah,
think it's Umar.
investing is not just for guys. All right,
Eh,
relax.
I think it's Umar.
Relax.
I don't know what you did, Umar, but you did something.
Don't
All
let me
right.
see what I want to say.
Say it. Do my best. Say it. Say it. I'll just
Sure.
delete it. I'll just delete it. The editing. All right. All right. So we have a lady. She's been investing in the stock market. She's been putting $500 into the market monthly. Market's been pulling back, and we've officially reached a point where the market is down 15%.
Mm.
She has decided that she's going to double her monthly deposit into the stock market from $500 to $1,000. She never stopped. She has an emergency fund, um, but she made sure that throughout this time, while the market's down, she wants to double how much she's putting into the stock market. Is it making sense or no?
Huh, this one is tricky. I mean, okay. So she's investing normally 500. Market is pulling back and she's like, "Okay, let me put more money in that." I think that honestly is a good strategy like we said multiple times in the episode. When people are fearful, this is when you should be greedy. And that's exactly what she's doing. She's putting more money in here. I'll say I'll say if I was in a situation, one thing I probably would do is that if even if I'm putting money, like I'll probably just put money in my brokerage account for capital and maybe not or like buy in chunks. So not necessarily like deploying all at once because you don't know where exactly the bottom is going to be. But if you're deploying like dollar cost averaging, that makes sense because now you're not just like just throwing all your money at the stock market and then if it ends up going down, you're still gonna be down. So I'll say just like if she has a strategy where she's buying like dollar cost averaging, I think it makes sense.
Yeah. Yeah, I agree. I think it makes sense. Like you said, as long as there's some type of strategy for how she's doing it. Even honestly, if we're being honest, if there's no strategy, it still makes sense.
It still makes
But it could make a lot more sense
it
with a
could be better.
strategy.
Exactly. It could
Yeah,
be
it could
better. It
be
could be
better
better. Yeah.
because regardless of what you're doing, if the market's down 15% and you double how much money you're putting in there, you're gonna feel it when the market's back up. But
Mhm.
like you said, there should be some type of strategic way you're doing it. So I agree.
All right. Okay. All right. Good. So we agreed on both, but we had different strategies to it.
Yeah, different perspectives a little bit, but those were good.
All right, to our next segment where we touch on economic events, basically anything in the financial or world news that catches our attention that we want to bring to our listeners. This is where we talk about it. All right, we can't start this off without mentioning SpaceX IPO. All right, so on June 12th, SpaceX IPO'd at $135. I think it opened at 150, honestly, because I was paying attention to when it opened. It didn't even open. One thing I noticed, it didn't even open at 9 a.m. Like
It
I
op-
was expecting, or at
it opened
8:30.
it opened
It didn't, yeah.
15 minutes later.
No, it didn't. Did it?
Whatever time it was like later.
Okay, yeah, because I was trying to see if it opened right when the stock market opened, but I think it was like later, maybe like 10 or 11, like 15 or something like that. But yeah, it opened at 135. I think closed at like 160, 165, about 20% increase from where it opened, officially making Elon Musk a trillionaire. How do you feel about this? Did you invest in it? That's what I want to know.
I don't have no thoughts on it. I didn't invest in it. I'm not interested in investing in it right now. And Elon Musk is a trillionaire now. I think the biggest story out of this for me is all the employees that got wealthy. I
Mhm.
like that. Like they said, like janitors, people that work in the cafeteria became millionaires off of this stock. I love stories like that. But Elon Musk, wow, he's a trillionaire.
What do you even do with $1 trillion? What do you do?
That's why I like what do I say? Oh, cause like what can he buy that Jeff Bezos can buy or that Warren Buffett can buy? You know, so yeah, $1 trillion. I mean, I guess he could probably go buy Meta if he wanted to or something. Well, he can't buy Meta, but he could buy one of those other companies. But a,
I mean,
$1 trillion is a lot of money, but I don't really have nothing to say there.
I think it's just like the headline that he's the first trillionaire. I think that's what
Yeah,
it is. But realistically, like there shouldn't be one person that has that
that
much
much
asset to their
money.
name.
Yeah,
Yeah.
it's crazy. It's crazy.
I saw
But
something that it was like he can spend $1 million every hour of every day for the next 100 years, and he won't finish.
all right,
$6 won't be over.
I'll one up you. Your net worth right now is closer to Jeff Bezos than Jeff Bezos is to Elon Musk. That's crazy.
No, that's
And
insane.
Jeff Bezos is worth 250
The
billion.
billion, yeah, is a
Uh,
billionaire.
yeah.
Oh my goodness.
So I'm closer to Jeff Bezos than Jeff Bezos is to Elon Musk. That is crazy. And that's number one and two in terms of net worth.
Yeah. So just going back to SpaceX, I mean, I didn't invest in it either. Obviously, like we said that we don't necessarily like investing in companies right when they IPO.
The IPO. Yeah.
So yeah, so just gonna be keeping a close tab to it to see what it's doing. I mean,
Hmm.
it's up already about 30% since. So let's see if there's a pullback. Maybe there's a re-entry that we can get into. But that's how I feel.
Yeah. I don't like how space stocks have been doing these past few, but I feel like it's a little bit of manipulation. I don't
Mm,
know that to be a fact, but we'll see how it goes. A lot of the space stocks have pulled back.
yeah.
UFO,
Yeah.
which is space ETF, hasn't been doing too great of recent either. Maybe
Mhm.
it's a good time to get into a position. But ASTS, Rock Lab, Planet Labs, they've been maybe by
They've been pulled back. Yeah, it's pulled back.
maybe by the time we release this episode, they'll be doing better. But I don't really like how they've been moving of recent.
Good, good, good.
Cool. Well, there's peace in the world again.
You don't say. Are you talking about the big man?
The Taco, he folded, which we expected. You have any thoughts on that?
Okay, I mean, yeah. Like, I mean, for people that don't know, basically we're saying that there's finally Trump finally signed the peace treaty. So the war with Iran has been called off. The Strait of Hormuz is back open. Did you see his tweet when
That I read the tweet and I'm like, this guy is different,
bro,
bro.
that man is a clown. He's a
He's
clown, man.
different, bro. Like,
He's a clown.
I read that tweet and I was like, okay, it is. It's cool. He brought the peace. It's cool. He
Mhm.
brought the peace. He got it. You got it, big dog. You brought the peace.
But I mean, no, I mean, finally, I guess finally we can say like, I mean, he's been saying this it was going to happen for months now. So finally it's happened. And then we saw that right when that news happened, we saw what happened in the market. There was a rally. Basically, I guess people feeling more enthusiastic about investing in the stock market. And so that caused a bit of a run up in the market. But I mean, I don't know how to feel. I don't know how to feel. I mean, we don't know if this is truly the end or what
If
else
it's
is
real,
going to
yeah.
happen. Yeah.
Or even if it is the end, really, what's next?
Mhm. Mhm.
Yeah.
I saw something that, the real president told him that I'm about to IPO, so you can't like
You can't mess it up for me.
you can't mess it up.
Nah, that Trump Elon connection is crazy because like sometimes they butt heads, but they really have a real bromance. They have a
It's
real
interesting.
bromance.
It's interesting.
It's
I don't, I,
interesting for
I don't
sure.
know if they're bromance. Maybe Elon thinks he's better, but you never know.
There's something there as well. There's something there. There's
Yeah,
some
for
type of
sure.
connection where they both trying to big dog each other, but they
Mhm.
both also have a respect for one another and they make money together. That is for sure.
Yep, yep, yep.
Yeah. I mean, like we said, let's see. Hopefully the peace lasts. Hopefully nothing else is coming up, but we know something else is coming up.
How do you feel about the FOMC that's coming up?
Yeah. You know, I think all the news that's going on in the world, I don't really know how to feel about it just because of all the things that have been going on. I don't really know how to feel about FOMC. Uh, you and I have been talking about these for some time that, you know, we're not going to get a rate cut. And they've confirmed that we're basically, there's no reason why we should get a rate cut,
Yeah,
that we should
inflation
probably
is
be
so
leaning
high.
more to hiking rates because of what's going on in the economy. But our president thinks differently. So I really don't, this FOMC will definitely prove and show to us who has the real power.
Mhm.
Is does our president have our Fed chair wrapped around his finger or not? And maybe they'll play it cool this first one and surprise us on the second one. But I don't really know what to think because I gotta see how Kevin Warsh. I gotta hear him talk. I like to listen to these things. I gotta hear him talk and hear the sentiment in his voice.
Okay.
So we'll see. By the time this drops, the FOMC decision would have already been made. So I guess we can
Yeah.
talk about it on our
We'll
next
talk
one.
about it on the next one for sure, for sure.
I'm just
And
happy
yeah.
gas prices about to go back down.
Oh, facts.
It's
No,
like
that
you got used to it, but it wasn't normal
nah, that was not normal. Nah, we're paying $4 per gallon in
in
Texas.
Texas. In Texas,
Nah,
that's crazy.
that's not normal.
Yeah.
But that's just going back to I guess the peace treaty being signed that okay, no more issues with oil and energy and stuff like that.
Mm, yeah, yeah. Oh, Bitcoin hit 59K.
Mm.
That was something.
Did you buy any Bitcoin?
For sure. Bitcoin, I've been buying Bitcoin, I've been buying IBIT, and I told
Oh.
you I sold my MicroStrategy.
Yeah.
It looked like he was playing the people based off what he did. And when I did it, I told you like he didn't sell a lot of Bitcoin, but the fact that he sold it was enough for me to like hop out.
Did they say anything about him like buying it back? Did he re-enter?
Yeah, he bought back. He bought back.
Okay.
So people were saying that maybe he did that to trigger Bitcoin to go lower so that he can then buy in at a better price, which that's what it looks like what he did. But just to add on to the point, if that's what you're doing, yeah, I'm good.
I
But
mean, yeah, that was interesting because yeah, that pullback. I mean, like going back, like you said, that Friday there was a lot of pullback that happened, and so that also affected Bitcoin as well.
yeah, 59K Bitcoin. My price is 55K. What, we're like halfway through the year. Maybe nah. End of the year. I'll do a recap of the analysis I did at the end of
At the
last year.
beginning,
Yeah.
okay.
So one thing I put in my thing, I think I was estimating Bitcoin at 55K. And I estimated that the S&P would end the year at 7,700. And I'm about to
Wrong.
be wrong on that because we definitely going above 7,700.
On track for that for sure.
Yeah, we're about to hit that in what, 6 months? It's kind of crazy to say because I believe my 7,700 would have reflected like an 11% year.
Mhm.
So to say that we got 11% in 6 months is kind of crazy.
I mean, that's what the market is looking like. Like they said, like people are not happy with 5-10% anymore. If you're in an asset and you're not getting 15,
40, 50,
20%,
the big
yeah,
numbers. Yeah.
you're seeing
Yeah.
stocks do 1,000 a year, 1,000% return a year.
For real. Yep. For real.
So yeah, different times we're living in right now for sure.
Very different times. Very different times. That was cool. That was cool. I got anything else before wrapping up the episode?
Oh no, no, I think we covered most of what's going on. Not much for me.
Cool, cool. Thank you guys for joining us for another episode of Common Sense. I hope you learned something in this episode. Key takeaways I'll have for you is do not panic sell when the market is pulling back unless it gives you a reason to. And do not FOMO buy at the top. I
Mm-mm.
don't think people realize how bad FOMO buying at the top is, but hopefully this episode has taught you something. On that note, make sure you guys like, subscribe, comment. It helps us in the algorithm. Tell us something you learned in this episode. If you learned anything in this episode, let us know in the comments. There's one thing you learned or one thing you appreciated in this episode. And if you really appreciate it, make sure you share this with somebody. Thank you guys for joining us for another episode of Common Sense, where we're all just trying to make sense of our sense.
Peace.